How's it going? I'm Andrew with Investors Hub, and there's a huge economic investment plan that's set on the horizon. People are estimating it's going to be $3 trillion. We're going to hear more news about it on Wednesday when Biden gives his speech in Pittsburgh. And yesterday we put out a video with JU from MarketBeat, and today we're going to be talking to Paul Schatz from Heritage Capital LLC. We chatted with him on Monday about what's going on with the economic investment bill and some companies that he thinks are going to be impacted by all this government money that's going to come spilling out of the sky. So just to put $3 trillion into perspective, the last time I looked, which was a couple of years ago, was that the average college-educated American worker makes like $2.5 million in their entire lifetime. So $3 trillion is over 1 million human lifetimes worth of economic force, I guess you could call it, being poured out into the economy. Please note that our videos are not designed to be direct investing advice. We're here to gather the perspective of different investors. Our channel and our content should just be one stop on the journey of trying to find out where to put your money. So, do you have any ideas on what companies would be most impacted by this infrastructure spending?
As we know, what they propose now and what they vote on, which may be in months or longer, may and probably will be very different. So this one is going to be probably the most fascinating of all time, obviously, because they're proposing such an astronomical number. I can't even fathom $3 trillion being put directly into infrastructure. So what I really think is it'll be a tale of two bills. You'll have a more traditional infrastructure bill that focuses on bridges and roads and tunnels and rail. And then you'll have a secondary bill, which will maybe focus on, electronic vehicles, more wind and solar. Because as we know, the moderate Democrats, which hold all the power here, I think they will get bipartisan support on this big kind of concept of traditional infrastructure. On the second one, it's going to be much more controversial, and I think they may have some trouble convincing some of the most moderate Democrats to hop on board. So let's start with the easy one, where I think more money will be spent, and that's on traditional infrastructure. The average investor, if you are okay with that idiosyncratic risk of picking stocks and trying to add alpha and outperform that way, sure, have at it. If you want to be more broadly diversified, probably the easiest way is an ETF, exchange traded fund, maybe one that does US only. So PAVE, P-A-V-E would be one way to play this. You get a basket of infrastructure stocks. You could also broaden your horizon a little bit, get less infrastructure centric and go into things like industrials, materials, and even utilities, which all have a multitude of ETFs and mutual funds to play it. So given that, if we go a step further and folks want to get more granular and really try to pick and choose which stocks are going to benefit, as we know, senators all want projects brought to their districts. That we know it's always been that way in the past. No matter what they say publicly, the earmark may come back, who knows? But I would venture a guess that certain senators will be more rewarded than others. So let's talk about a bunch of stocks. Number one, you got Brookfield Infrastructure. Brookfield, it's got 90, $100 billion in infrastructure assets. It's a broad way to play the infrastructure game. So that'd be one. Crown Castle and American Tower are both similar. That's a plan. We know that Biden wants to bring broadband to all the rural communities, and they want to upgrade 5G everywhere. So what do you look for? You look for basically the cell tower industry. Crown Castle, American Tower, those are two really good pure plays in 5G, in broadband. Then you look and see, okay, how are they going to build these bridges and roads and tunnels, et cetera? Well, they're going to look for the largest U.S. steel producer, and that's Nucor Steel. So that's an easy one. Biden was talking about getting into the water, making water better and improving on the quality of water and our very aging water systems. There aren't great pure plays in water. Advanced drainage, symbol, I think is WMS, is one of them. Certainly, there are some ETFs, PHO is one, but they're not the greatest pure plays. Water normally falls under the industrial category. Let's move on to another part of infrastructure, which would be the materials that are used in all this projects. So Vulcan Materials is the biggest. I think it's the best. For full disclosure, we own a large position in it, as well as Martin Marietta. Both are gravel and rocks and all the things that you get out of quarries. They all need in infrastructure projects. Industrial metals would be another part. And then you look to Brazil and South America. There are three big companies: Vale, BHP Billiton, and Rio Tinto. So that's it there. Who's going to push all this stuff around the ground? Who's going to carry the load? Well, we know Caterpillar and Deere. There's no infrastructure project probably on earth that doesn't include either Caterpillar or Deere. And my final two would be, assuming we're going to use a lot of copper, which is all indications say we would, FCX, Freeport, that's a great pure play on copper. And finally, United Rentals, which, if you've ever driven down Route 1 or any of the main roads in America, you know that there's always a United Rental dealer to rent all kinds of machines to do some of these smaller projects. So that's the big nuts and bolts, the guts of the plan, if you will.
So do you think that this investment will be a case of entire sectors being lifted, or will individual companies succeed in expense of, or at the expense of, their competitors? My thoughts are wondering, like, how much are investors betting on the idea that their chosen company is going to be the one that gets chosen for infrastructure projects?
So the biggest money from an investment standpoint is going to be made in choosing those individual companies. If you're going to spend, if they're really going to spend $3 trillion, really and truly, which I still have doubts, but if they're really going to spend $3 trillion, we know that it's going to be mostly American companies, the vast majority American companies. And we know that they're going to have to place an awful lot of money in contracts with a lot of different places. So that rising tide is going to lift all the boats, but certainly not to the degree of equality. Some companies will see a 10 to 15, 20% benefit. Some companies are going to see their stock prices go up a whole lot more because of it. So again, if you're that individual investor, you have to figure out how much work you want to put into it. I just gave you a whole bunch of names that seem intuitively to make sense for a project. $3 trillion. You can't even fathom how much money that was. The recovery plan in 2009 was $787 billion, and that was considered monstrous. So $3 trillion means so many companies are going to benefit. Again, you don't want to do as much homework. Buy a couple of ETFs, exchange traded funds, buy some mutual funds that focus on industrials, materials, or infrastructure. And I think you should be fine. If you want to do some research and you enjoy that, dive into any number of companies that I already recommended, or you can find your own. And I didn't recommend Eaton. Eaton is a kind of a conglomerate that, if we do the second part of the plan in wind and solar and electrifying America, that's a whole separate group of companies that possibly could benefit without ETFs to really take advantage of. I know people will say there's an ETF TAN, but I think if they do the second part, there'll be plenty of time to do some more research to figure out which companies will benefit from wind, solar, and the electrification of America. But remember, if you buy individual companies as an individual investor, you have that idiosyncratic risk. You can go to bed one day and the market's at an all-time high and wake up and find out that the CEO just resigned over accounting irregularities, stuff like that. So just, caveat emptor, buyer beware.
So do you think that this government spending is going to drive inflation fears? I know that bond yields have been a big sticker for the market, and inflation drives bond yields. So think that's going to happen?
I think it's already happened. The inflation genie. Inflation typically runs in these grand 30 to 40 year cycles. And when you have cycles that big, we don't exactly have tons of data going back to, 1,000 years ago. But if you're of the opinion like I am, inflation last peaked in 1981. and went down for roughly 40 years to this year, last year, wherever you. I think the inflation genie popped out of the bottle in the middle of 2020. I think she's out of the bottle for a long period of time. On balance, I think inflation is going to trend higher for years, if not decades to come, but it won't be in a straight line. So to answer your question, I think this is the first inning of a 9-inning ball game for inflation. You're going to have fits and starts. You'll have recessions or periods of weakness along the way where inflation moderates. But this is the first time in history where you have the Fed and Congress both printing unfathomable, unthinkable amounts of money. Now, just printing money doesn't create inflation, contrary to textbooks and popular belief. Inflation comes about because people begin to lose confidence in the currency. So Great Depression, the Fed and the Treasury were way behind the curve. They waited years to take necessary action. 07 to 09, the Fed was there. The Fed started to move in 07. They were clearly late. Congress didn't move till 09. They did it in bits and pieces. With the COVID crash and the Corona crisis, the Fed and Congress moved instantaneously beginning in March, April of 2020. So all that money comes flooding in. It's going to find its home. That's going to lead to, and it has led to, a 200 and something % increase in the 10-year bond yield from 0.5% to 1.7-ish%. And we're not done. It's not going to be a straight line from 0.5% to 1.7. I think mid second half of this year, bond yields go down again. People go sigh of relief, and then they go higher again after that. But in my view, clearly the inflation genie is out of the bottle. It's not going to be a repeat of the 70s where we had the oil embargo and the oil shock. This is a different kind of inflation. But for me, it's here to stay. I think food inflation due to shortages globally, you're seeing just that one little incident in the Suez Canal, frankly, caused all kinds of disruptions around the globe. And that was only a couple of days long. I think the theme for the 2020s will be of shortages. We see it with some graphics cards, as my two sons, aged 13 and 15, are hawking me about. Got to buy more graphics cards because they're in short supply. That's the theme to me the rest of the decade. Higher interest rates on the long term, certainly higher inflation.
Any final thoughts?
I think it's like everything else in investing. Investors can't just look at the last crisis, the last time something happened, to position their portfolios now. Markets are amazing at rhyming. They don't exactly repeat. So what I would say to the individual investor is, when the masses all give you that one solution for the problem, the masses are usually wrong. I would subscribe to look at other places to help, if not hedge against your inflation, take advantage of inflation, take advantage of what will be an unthinkable amount of money being spent on infrastructure and other things. I mean, schools haven't been upgraded in, decades. So all these things are going to happen. Don't sit back and let the markets come to you. Go out there and proactively try to take advantage of it. But like everything else, have a little plan for defense in case things don't go your way, because everything, obviously, in investing never goes our way perfectly.
So do you have any disclosures? I know you mentioned one earlier on, and you mentioned a lot of companies. Do you have any positions in any of the companies mentioned?
We have as I mentioned, we have a position in Vulcan VMC for sure. We have a position in Caterpillar. We certainly have positions in industrials and materials on an ETF and sector basis.
Thanks for watching. And if you like the video, be sure to like, comment, and subscribe. You can also follow us on Twitter at @IHub_Vision. And I'll see you again soon.